Joshi also joins us on the show. Mayuresh, what do you make of this rally that we are witnessing? I don't know what to call it, what adjective to use, because it's just a very stupendous move, 1,600 points on the Bank Nifty.
Afternoon, Anisha. I think it can be a pre-election stroke Santa stroke Christmas stroke anticipated rally. So I think all the ingredients in the right place as we are seeing and as the market is anticipating the moves that the mandate has probably given. So I think the next 5 years visibility largely there for the markets. And to a large extent, what the markets were largely fearing before the state election verdict were on two counts. One, on the state election front itself. If any opposition party came through, the kind of freebies that were announced, state borrowings would have definitely got higher, relating to higher central borrowing, gross borrowing getting higher, and therefore a dent in terms of the fiscal deficit numbers. The second element in terms of the sheer number of seats and the margin of seats that BJP has won, it also gives them an additional 143 seats in the Rajya Sabha. So as the re-election process comes through in the next 2 to 3 years, there is an absolute chance of a lot of bills and reforms getting passed through because of absolute majority in both the houses. So I think the political stability is something that the markets are cheering significantly. On the economic front, both macros and micros are holding out very well for India compared to the rest of the group. And therefore, I think it's a twin move, both political and economic, that the markets are probably rejoicing.
Mayuresh, purely looking at the quality of names which are actually perking up within the Nifty Bank, it gives you conviction that finally FIIs are going to return back. I mean, of course, we'll know it only later in the day what the FII participation figure was and whether it was a buy or not. But just look at the names. Kotak, ICICI Bank, HDFC Bank. Seems like the next leg of the bull run is going to be finally led by FII participation and those skewed stocks.
Afternoon, Aisha. Oh, absolutely, yes. And to that viewpoint, a large element in terms of the FDI flows that came in the last fiscal, $70 billion or dollars, 46 billion came into the equity markets. A lot of money is still waiting to come in, and that's our discussions with a lot of stakeholders who are based out of India. And obviously, I think this mandate that has come through is going to create a huge impact in terms of those flows starting sooner rather than waiting for the Lok Sabha mandate. Having said that, financial services as a space obviously is looking very, very attractive compared to the rest of the globe as we speak. I think a lot of global banks are probably facing a lot of pressures, both in terms of the bond movement that has happened at the M2Ms that they are facing. Our banks much better off. A lot of banks, as you discussed, case in point being ICICI Bank, has largely done nothing for a periodicity of 1 year. So I think it's been a flattish kind of a return over a year's time frame. And therefore, this stock should definitely be on your radar and on our watch list as well. Decent set of numbers, expectations in terms of the new circular that RBI has put forth on unsecured lending. I think that would not have such a significant dent for the larger banks because their CET1 ratios are significantly higher. And they've got every scope in terms of having some dilution come at some point of time going forward. So as the rate cut cycle gets initiated at some point in the next year, I think all of these large banks which have largely outperformed, ICICI, HDFC Bank, should come roaring back. So yeah, both these banks should definitely be on your watch list.
It's intriguing to know it's actually not Maruti, but it's actually Hero and Eicher which have led the charge in the last lap of the bull market.
I think the initial leg, the two-wheeler move that happened, TVS Motor has been a huge outperformer. Bajaj saw a catch-up rally. And now you're probably seeing Hero and Eicher probably do the same. What you've probably seen in terms of the new launches, and all new launches have got accepted very, very well. For Eicher, I think the product mix is pretty stable as we speak, and it's well accepted in terms of even the new Hunter launch that they did a few quarters back. And therefore, I think export markets holding up, the spares business is almost 10%, holding up equally well. And expectations in lieu of competition, where pricing should also hold up with volume staying stable. And valuations probably for both of them not as high compared to the rest of the pack. Probably something which gave impetus to the rally. So yes, I think the rally might very well continue for auto stocks. A lot of tailwinds in terms of demand, footfalls, more products getting introduced on the mobility pack, whether it's two-wheelers, four-wheelers, should keep all these stocks probably in the limelight. But along with that, I think auto ancillaries as a pack, Aisha, is something that you should not forget. Because to a large extent, they are servicing both these original equipment manufacturer at this juncture, and also ramping up capacities for the electric mobility part and serving the replacement markets as well. So I think it's going to be a triple bonanza for these guys over the next few quarters and years.
The best strategy to go right now for our retail investors, or do you think direct investment is something that they can still continue with? And I ask you this question, given there is this record high level on the mid cap and small cap index, most of the sectors are sitting at record high, and one is a bit limited with respect to ideas where one should put money.
Absolutely. I think the best way to do is do a SIP, Anisha, and you're absolutely right on that. Because the markets are at an all-time high level. And obviously, I think it's not going to be a linear journey over the next few quarters and years. You're going to get these intermittent breaks, and we'll peg our excuses on global cues or any other factors that will come through. And that does provide an opportunity in terms of reducing the impact cost. Obviously, I think as these breaks come through, I think a lot of retail investors have become far more mature at this juncture. So I think they have ridden this trend very, very beautifully through their SIPs. We are seeing an increasing trend in terms of the SIP allocations actually increasing. And therefore, I think having an appropriate mix, even within the mutual funds, within large caps, multi-caps, and also the mid and the small cap universe should be the mantra to be followed. Direct investing is for those who are a little bit more comfortable in terms of looking at the markets, analyzing the markets, reading through in terms of what you understand from the markets itself and what you best understand where you want to invest, the businesses that you find easy to complement. And that's not easy for an average retail investor. So I think SIPs is the way to go. And I think that is the best way to probably compound your wealth and make money over the longer period.
SIPs is one of the ways to make money. Let me throw it to you, Mayuresh. Give me your top banking bet right now, one stock that you like.
So Axis is something that we continue to like, but I think it's moved a little bit too much for our comfort. So I think, as I discussed in my opening remarks, ICICI Bank is something that we'll definitely have on our watch list. Numbers were pretty decent. You've seen a decent amount of NII growth, some compression in NIMs, but that was expected in the quarter gone by. And as advances growth improve over the next few quarters, with a steady accretion that we're probably looking in the deposits as well. Even with the new RBI circular, as I said, it's just a 60-70 bips kind of a hit in terms of the CET1 ratios, but it's already pretty decent, which means that the balance sheet growth can continue for the bank. Provisioning is reasonably high, and therefore we're probably looking in terms of improvement on return ratios going forward is something that we can look out for. So I think it's largely been an underperformer of the past 1 year. Our take is that this bank might be one of the better performing ones in the coming few quarters. So yeah, ICICI Bank definitely.
Within industrials and infrastructure pack, Mayuresh, where will the preference lie? Would it be L&T, which is high by 4% today, or would it be more industrials, the likes of BHEL or even Siemens and ABB for that matter?
So yeah, I think anybody holding on to L&T can definitely hold on. It's part of our global focus list as a disclaimer. And a proxy to the Indian economy. L&T has been playing this very, very well over the last few years and will continue to do so over the next few years. Very strong order book, working capital cycle has reduced to a large extent. EBITDA margins are far more stable as we speak. But I think one stock that we probably like is these construction equipment players. So Sunway Movers is something from the mid-cap universe that we like at Marketsmith India. For the last year, Anish, I think numbers in terms of top line were 455 odd crores with a margin of 62 odd percent. I think margins should see steady and stable performance going forward at 62, 63. Going by the first half numbers, top line should be close to 600 odd crores, which is a growth of 25%. Utilization levels at 83 odd percent as we speak. They have added 24 new cranes in the quarter gone by. And with the visibility that we're probably seeing in terms of capex, the infrastructure spending from the centrals and the states, I think Sunway Movers can be one stock where the utilization levels can inch up even higher, creating a better yield. And with debt equity at 0.34 times, I think this stock can do well even from the current levels. So I think L&T from large caps, Sunway Movers for the mid caps.
L&T from large caps, Sunway Movers from mid caps. Those are ideas coming in from Mayuresh. But